Welcome to my video on banking. Myself, Dr. R. Pavithra, Assistant Professor, PG and Research Department of Commerce, Sri Sharada College for Women, Autonomous, Salem 16. In this video, I am going to explain about Donatia Mortis Causa and KYC, which means Know Your Customer, and why it is important. We are also going to see about passbook and its important, crossing of check, what is negotiable instruments, and its key characteristics. So let's get started. First, we'll see what is meant by Donatia Mortis Causa. Donatia Mortis Causa, in short DMC, in banking this refers to a gift made in contemplation of death, where the donor transfers an asset to a donee with the intention that ownership will take effect only upon the donor's death. This type of gift is conditional, meaning it can be revoked if the donor survives or changes their mind before death. In the context of banking, a donatio mortis causa might involve a person handing over a bank deposit passbook, a signed check, or any other financial instrument to the recipient with instructions that they may claim the funds only if the donor passes away. Courts often scrutinize such gifts carefully to ensure they meet legal requirements, including the donor's clear intention, actual delivery of the asset, and the donor's contemplation of imminent death. Now we'll see about KYC. KYC is nothing but Know Your Customer. KYC norms refers to a set of guidelines and procedures that banks and financial institutions follow to verify the identity of their customers. It involves collecting personal data such as name, address, date of birth, and financial background through official documents like Aadhaar, PAN card, passport, voter ID, or other utility bills. Why know your customer is very important. KYC is crucial for several reasons. This ensures that the customer is genuine and it prevents unauthorized transactions. KYC helps in tracking suspicious transactions and complying with anti-money laundering regulations. KYC protects both banks and customers from financial crimes. Banks must follow KYC guidelines mandated by financial regulators like RBI in India. KYC promotes a secure and trustworthy banking system by verifying customer details before opening accounts or processing large transactions. Therefore, KYC is mandatory for opening bank accounts and for availing loans and for conducting high value transactions. Now we'll see what is a passbook. A passbook is a small physical booklet issued by banks to account holders that records all transactions related to a savings or current account. It contains details such as deposits, withdrawals, interest earned, and account balance, helping customers track their financial activities. This passbook contains details such as deposits, withdrawals, interest earned, and the account's balance, helping customers track their financial activities. Now we'll see the importance of a passbook. Passbook provides a detailed record of all banking transactions, ensuring transparency, and it also helps in easy tracking. It serves as a proof of financial stability, often required for loans, scholarship, and government benefits. Passbook helps in matching personal financial records with the bank records, identifying any discrepancies. Unlike digital banking, a passbook does not require an internet connection, making it useful for those with limited access to online services. This passbook also acts as a legal proof of transactions and account balance. This is also useful in disputes or financial verifications. Therefore, passbook remains relevant especially for individuals who prefer traditional banking methods or need documented financial proof. Now we'll see what is meant by crossing of check. Crossing of check is a security feature used to prevent unauthorized encashment of a check. A crossed check has two parallel lines drawn across its face, sometimes with additional instructions like account payee or not negotiable. This ensures that the check amount is deposited only into the payee's bank account by reducing fraud risks. The basic objectives of crossing check is to prevent from unauthorized encashment. A crossed check cannot be encashed over the counter at all. Therefore, it must be presented into the bank account, ensuring security. This minimizes the risk of theft or loss, as only the intended recipient can receive the funds. An account payee crossing directs the bank to deposit the check only into the specified payee's account by preventing it from misuse. Since crossed checks require bank processing, fraudulent endorsements or alterations are harder to execute. It promotes transparent financial transactions by routing payments through bank accounts, aiding in financial tracking. By using check crossing, banks and customers ensure secure and traceable transactions by reducing financial risk. Now we'll see what is meant by negotiable instruments and some of its key characteristics. A negotiable instrument is a written document, and this guarantees the payment of a specific amount of money to the bearer or a specified person. It is freely transferable, meaning ownership can be passed from one party to another. Some common examples includes check, promissory notes and bill of exchange. Some of the key characteristics of negotiable instruments such as a negotiable instrument can be transferred from one person to another either by delivery or by endorsement and delivery. It contains It contains an unconditional promise or order to pay a fixed sum of money, meaning the payment is not dependent on any external conditions. Thank you.